The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. George, good to see you. We're not going to talk about the budget. We're going to talk about birthdays. Anybody you know had a birthday lately?
Oh, my beating heart. You're straight in there, Ian. Thank you so much. Yes, it's all celebration in the O'Connor household this weekend because ChatGPT 3.5 has turned 3.
Hooray!
The sense of awe remains. Product still in its infancy, but already profoundly disrupted to our lives. Now, the problem is that with our hyper-connected world, sometimes it's almost impossible to get the causal relationships and correlations. But so much has happened over the past 3 years since this bad boy came on the scene. Now, tech salaries have been the big casualty. So over the past 3 years, if you're an IT contractor, you're looking at a day rate which is 8.2% less, 15% less on full-time rate. If you're looking at the index in terms of tech market in the UK, it's up 27%. If you're a HP employee today and you're one of the 6,000 staff that they're looking to exit the building, you're also blaming it. So an absolutely huge move really, for me, drove the current wave around the AI in the industry. But wow, happy birthday, ChatGPT.
Happy birthday, and thank you for all you've given us over the last 3 years and what you might give us still.
Anyway, speaking of the gift that keeps on giving, Ian, what have you been up to this week?
What have I been up to? Been a bit of a runaround on the last few sets of results out from the UK small cap boys and girls. We've had the likes of Cerillion, Molten, GBG, ActiveOps, yes, Auction Technology, TrueVision, whole host of companies.
Hang on, give me your thoughts on ActiveOps.
ActiveOps.
I did the TSR year-to-date charts before this, and ActiveOps shares are up 117% year-to-date. Wow.
Yes. Is this another Filtronic, a company whose time has come, shall we say? It hasn't taken ActiveOps quite as long as Filtronic has.
I've got to say, I love your underlying thinking here. There was bad before the good, which in fairness is bang on the money with it. This has taken a while to deliver. What's your analysis?
Obviously, I've seen them from afar and looked at the numbers and tried to understand what's going on with this business. I thought, yeah, that's a neat little business, but is it going to be just a neat little UK small cap tech story? The valuation, which is something on 4 times sales, might suggest no, as far as some investors are concerned. But the way in which it was being presented in the short term, the way in which you look at it in the short term, I find that difficult to get my head around. Because looking at the short term, looking at what they're talking about, their EBITDA margin is only 9%. They've set this rather grand ambition of having an ARR of £100 million, which is up from 40 odd. And an EBITDA of 25%. But when you play with the numbers, that's quite challenging given the way in which they're running the business in terms of the sales model. Now, the analyst meeting was very short term. We were, what product upgrade is there? What are you doing here? How many employees you have? But I can't see how this business takes a proper step forward unless it gets itself a proper channel strategy. Because just knocking on doors and saying, hello, we're ActiveOps, can you try our product? It's not going to work. It's not going to generate a really good business. And they have changed the sales team. They are hiring new people who are more aggressive, who set more aggressive targets in terms of minimum sales. But for me, I want this to work. I think it should work. But I feel that the conversation that they have, if that meeting this week was any indication, they're just going to sort of stagnate under the sort of apathy and reluctance of the UK investor base to say, go on, spend it, get to the scale, get to the level of revenues. It doesn't matter about EBITDA. Get to the point where the channel partners recognize you and see value in you. Because at the moment, not quite there.
Although in fairness to you, you have identified that GTM takes 2 forms, your work and partner work. And on that, they have hired new quota-carrying people, which you've mentioned, and they are of different calibers. So I confess, I know a couple of the guys in there. For me, they totally tick that box. In addition, I was at their customer event a month and a half ago, and they were channel partner potential, and you're thinking implementation typey people who have access to much larger transformation-y type budgets.
People who are already in the door.
Great point. So they were there, but you are right in the sense that there's been a slowly cautious. Company is 15 years old. You've got a founder, CEO in there. But for me, it's starting to come together. And what they don't want to do is just throw another log on the fire. I know you've talked about a couple of the KPIs, but another couple in there, NRR of 114%. So they're selling and holding on. And presumably that there's some upselling in there as well. In addition to that, new customer wins. So for the period, they had 5 new customers. They got 3 this time last year, and prior H124, they had 2. So there is momentum creeping into the business. For me, the issue is, as you looked at it with a fresh pair of eyes, would you think, oh, wow, share price has done really well. I should be taking money off the table and parking it elsewhere? Or were you thinking, oh, wow, now they've got a platform, I can see how this scales globally. We're all in.
Yes, it's trying to understand what's driven that share price up. As an ex-broker, you have a feeling as to how markets work and how messages work. There was nothing in that meeting that said the market gets where this is going or could go on the sort of channel story. It's all very, we're seeing improvements, we're seeing improvements, we're seeing improvements. If you're guiding towards 25% EBITDA and if you can't achieve breakthrough scale,
right,
and 25% EBITDA, your fund managers are going to demand 25% EBITDA and screw you, and then wonder why everything falls apart.
I can sense them already shifting uncomfortably in their seats as you put these questions to them in an open forum. Kudos to you for doing it. That said, you mentioned there was a print out from Cerillion this week. Cerillion has been a massive win in terms of UK investors. Hasn't been a particularly great year for them this year. What's your call on that?
Well, after several very good years, there's a little bit of a pause for breath. The share price has come back, but given the 3-figure returns you've had for several years almost from this business, you can accept that. The business is still going forward. The management are talking about back to double-digit growth rates next year. No particular reason to doubt that.
Although the 4% growth this year does sort of undermine the argument. Or was this year a rogue wild card?
A rogue wild card, yes. It's a lumpy business. This is, remember, still a software business in the old school. The largest customer last year was £13 million, which is over 29% of the revenue. So we still have to think, it's going to be a lumpy business. It's going to have a lumpy share price, perhaps. That goes with the territory of being an old school software company, I'm afraid.
Ian, as it is an old school software company, you mentioned margins. This is a massive margin company. Shouldn't this really reconfigure as a returns, not a growth tech?
It's an interesting situation you have there, isn't it? Could you just give all the money back and just chuck it off? They do chuck off cash like crazy. But you have this situation where they have the big boys who are very, very big boys ahead of them, the sort of Amdocs, where Amdocs charge the earth. And that gives Cerillion an opportunity to charge a fair amount of money, perhaps more than you might expect in terms of what you get for your people. I see the 51% EBITDA margin almost as a function of the competitive environment, not anything they particularly do themselves, if you see what I mean.
Okay. The only other thing, just for me, looking at the makeup, is that they pay their staff cheaply relative to the sector at large. Is any of that to do with them being based in Ireland?
Based in Ireland? They have operations in other countries. Let's remind ourselves where
Sadly,
they are.
Dublin is more expensive than London. So it isn't. You mentioned amazing cash. They've got an FC, a free cash flow margin of 25%. This is like an amazing business.
It's a whopping great gap they have in the market to run around in, where the big boys don't go and the little guys can't address.
Now, you mentioned GBG Group. The CEO knows there are problems in there. And then we've also got David Ward in there as CFO, who we all know from his Aviva days. Appreciate that there are challenges. Did you change your mind? Anything leap out at you from it?
Not really. He is just getting on with the job, really. We have to
Yeah.
accept that he had 16 odd platforms. He's down to 14. Great.
Yes.
And he also said, oh, yeah, those 2 that we're getting rid of, they were the easy ones. It's going to be hard work, this business.
He was confident of America's returning to growth in H2. Is that a refuge?
I can't see anything to get excited about with this business at the moment.
As I talked up NRR at ActiveOps,
101.1%.
yeah,
There you go. But the last 2 years, it's been less than 100. So they are keeping hold of people and grabbing a few more sales. But the contribution margin in this business is 40 odd % in location, 28% in identity. The fraud is 39%. This is not sexy software stuff. This is hard grunt.
Agreed. We started this conversation talking about the birthday party for ChatGPT. At the same time, though, as we think of the wider repercussions of it in terms of where we are and where is the industry headed and what are we thinking about generally. I was looking at the Autodesk print earlier this week, but what they did do is talk about their new transaction pricing model. So the underlying idea is that they're going to pull revenue rec forward to the moment of the transaction, the order, the renewal. So that will raise the growth metrics in there. Now, it may well create issues further down, but for the short term, it just makes everything look better. The challenge is going to be, what if anything goes wrong through the usage cycle?
Yes.
What if usage just gets smaller rather than continually rising? And then we get into the challenges that companies had when they were trying to switch pricing to consumption-based terms around remaining performance obligations. But the underlying challenge that they're trying to address is saying there are going to be fewer seats. We're selling on seats, subscriptions based on the number of seats. If the seat is a robot, what do we do? Ian, do you have any concerns about this model?
Well, anything that is dependent upon seats, and we're going into our current economic situation and we're looking at robots, you have to be challenged. You have to worry about it.
Yes. So the issue here is that you have copycats aplenty, but investors get concerned on accelerated rev rec. And then although the numbers are better, you actually see the sector derating as a consequence of increased risk rather than, woohoo, the numbers and the KPIs are all moving in the right direction.
How do you think the dynamic works in these markets? You say that there are challenges. Is it the challenges that are going to feel the pain, or is it going to be the Autodesks, the big boys who can sit back and say, actually, we know that the guys who pay the full whack are the guys who keep their jobs because they're the senior guys? Or am I over-assuming there?
Yes, so I just think the concern is very provincial. I'm selling on a seat-based model. I mean, okay, so you can say, George, the software industry has changed how it sells many, many times over the years. And as they've moved away from one-time charge, the positive has always been they've tried to de-risk the model from a rev rec perspective. So make it more investor friendly and create better valuations because it's about transparency. Here, you have the opposite starting to appear, where you have less transparency, where you're accelerating, i.e. pulling forward revenue. Now that will have the effect of pulling forward increasing profitability in that initial stage as well.
And it's not as if people can't notice this.
So then you've got a lot more work in terms of teasing out how the old model and the new model compare. But at the heart of it is the issue raised by ChatGPT 3.5. Fewer people, more robots. So the industry has to change to this. The same discussions are happening in the IT professional services industry, where they're also looking to change from guy and gal pricing, i.e. time and materials, into outcomes-based pricing. So as we look into 2026, this is going to be one of the big issues. And I think lots of people will look at it, but I'm not sure how quickly the whole world will adopt, just because everyone remembers that the headaches around consumption-based pricing and RPO. In terms of the investor world.
They'll go and try and work out what the returns are on AI spend again, because we know that there is no answer. Therefore, let's concentrate our time on looking at the unanswerable rather than the things that we can resolve and understand.
On that bombshell, questions and queries about the ROI on AI. I don't know where I am. I'm in a weekend of celebration. Ian, delightful to chat.
Good to talk to you.
brought to you by Progressive Equity.